Welcome back to Regan Mac. We're going to continue to talk about fiscal policy. So here I'm going to jump into taxation. So there's an exercise, an empirical exercise that I want you guys to work on, and we're going to talk about that in the virtual class, and that's right before this slide. So if you just hopped in now, please make sure that you try to solve that exercise, and I'm incentivizing you to hop in the virtual class so we can talk about it, okay? But here we're going to really dive into taxation. So for taxes here, we're going to focus both into how the federal and how the state and local governments perform their taxes so they can raise revenue, so they can spend money and help the economy grow. Okay, in terms of the federal government, if you look into the federal government revenue in terms of tax receipts, you can see that if you have this idea that government's been increasing taxes relative to the size of the economy, over time you can see that that's not the case. Now, of course, there's a big question about who is paying all those taxes, and then maybe that's something that has changed over time, right? But overall, in terms of the size of the economy, you can see that we kind of see a downward trend in terms of government receipts, in terms of tax payments over several years. Okay, you can also start to see how it goes up and down, especially given economic scenarios. So, for example, in 2007, you can see that when we hit the recession, tax receipts went down, but you can see that after that they bounced back up. Right, so during contractionary periods, you see lower tax revenues, and during expansionary periods, you see the tax revenues going back up. Something to start noticing as we move along in this chapter. Right, there's, especially for the federal tax revenue, there's different types of taxes that we can think about. We tend to think about the income tax as the main one, is the one that we tend to pay as soon as we get from under our parents' tax, right? So once we're not dependents anymore. But also the ones that maybe have experienced even before you get older, which is the sales tax, right? But if you think the sales tax is the first thing that comes to your head, the point of me mentioning is that this is not a federal tax, right? This is actually a state and local tax. So you can see the importance here of understanding the types of taxes you're paying and who that goes towards, right? Because why are you going to complain to the federal government about sales tax if if that government's not the one imposing that tax on you? Okay, so once again, the federal taxes here is going to be based on income, is going to be based on payroll. Okay, some of these are applicable to choose. So you see that the state also has a payroll tax. Okay, but for the federal government, that's going to be known as the FICA tax. Okay, so this is used especially to fund Social Security, insurance, and retirement. So this program is actually funded by workers that are working right now. So if I'm working right now, I'm contributing to that fund. I'm funding people that are receiving the Social Security right now, which will be a problem when we talk about how the age of the population has shifted over time. Okay, so that's something for later slides. There's also a tax over corporations' profits, right? That's the corporate income tax. Okay, so there's a federal tax on how businesses are making profits. And as we know, this just went down from 21% from I think 35%. Okay, so Trump engaged in his new tax cuts when he was elected, and you see that definitely impacted our economy in terms of tax revenues as well. Okay, it's important to start noticing how those things are going to impact us. There's also excise taxes, which are taxes on things that the government trying to disincentivize you to use. So for example, a high tax on alcohol means that they're trying to disincentivize you from buying more alcohol, right? So that's the excise tax. It could be on tobacco as well, on gas, if they're trying to avoid you from pollute the environment. So you can try to see different types of taxes that can also change behavior of society. That's important to point out here, right? They have those types of intentions too. There's a gift tax, which is pretty much a tax on the transfer of wealth, from one individual to another, while there's not an exchange, so just a transfer of wealth from one another. But also there's state tax, which is a tax on the transfer from properties when somebody dies. Okay, so as you can see, there's several different types of taxes. And there's also tariffs, which are taxes on imported goods. So just wanted to point out different types of taxes here. You can see out of the entire federal tax revenue, what share those types of taxes have played a role. You can see that personal income tends to be pretty stable in terms of its importance. You can see that payroll tax became more important, especially since the 80s, and how corporate income tax went way down since the 80s, right? So you can start to see some trends here about how government has reacted to different types of economic situations in the past 2-3 decades, right? You can see here as well as another way to show that graph, but you can see that despite somewhat being stable, a lot of the changes has happened since the 80s, and that has pretty much stabilize the shares of expenditures of tax revenues in terms of the size of the economy for the federal government. Okay, so let's talk about some of those taxes in a individual, in a case-by-case manner. Okay, so first, income tax. Income tax we tend to hear a lot about, and is one that also got a tax cut whenever Trump got elected as well. So this is based on an adjusted gross income, so an income that out of the income that you make, there's a certain amount of deductions that can be made to that income, and the adjusted gross income already accounts for those deductions that can be made. Okay, this is a marginal tax rate, so it's based on each dollar that you make, each extra dollar that you make, and we'll do an exercise in a second to show you how that works properly. Okay, one thing that I want to point out here, you're going to start noticing different types of taxes in the U.S. economy. This one especially, you're going to see it's a progressive tax. Why is this important? It's for you to understand what distribution of the population is paying a higher share of this tax. So in the progressive tax, we're talking about as you make more income, you pay a higher percentage of income in terms of taxes. Okay, so it's proportional to your level of income. Now, one argument against it, maybe you're saying, well, this should be the case because if you make a lot more money, you can pay more taxes than somebody that doesn't make a lot of money. Fair point. But also there's a disincentive of work here. Right? If you're taxing individuals that make more money, then you're disincentivizing them in a way to get to those levels of higher income because they're going to take advantage of less and less of the amount of money that they make because they have to pay a higher share of taxes. So something to think about, the consequences of different types of taxes, right? It's really easy to argue for one when you're not suffering the consequences of it. Okay, so just to give you an idea here how this works, in 2018, this is how the tax bracket was changed. And you can see here exactly how your bracket, which bracket you'd fall if you're single or if you're married and filing jointly, okay? The main idea here you can see is that, for example, if somebody makes less than $10,000, they would pay a 10% tax rate. Somebody that makes between $9,525 and $38,700 would be in the second bracket. Does that mean that all you do is multiply that income, let's say $30,000 by 12%? No, that's not what a marginal tax rate is. So this exercise is going to give us a good idea about how to understand this analysis. Okay, so let's solve it together rather than solve it on your own. And please try to do this on your own later. Pick a different number for income and see if you can calculate. And once you calculate that, send me that number through email, and I can check to see if you did that right, and we can discuss it if needed. Okay, so this is the idea. Imagine here that someone is single, and I already put the tax bracket here for single individuals, as you can see, and they make an adjustable gross income. So after adjusting for things that can be discounted from the gross income, they have $40,000 in terms of income. Okay, so how much income tax does this individual owes to the federal government? Okay, so income here is 40K. Okay, so does he pass the first bracket? Yes, he makes more than $90,000. The $9,000, sorry. Does he make more than $38,700? Yes. So we know that he's going to be he's going to get all the way to the third bracket. So how does this marginal tax bracket work? Well, it's based on each dollar that you make. So for example, the first $9,525 that you make that year, they're going to be taxed at 10%. Okay. So in that case, since we know that this individual makes $40,000, which is more than $9,525, we know that he's definitely going to get charged $9,525 at the rate of 10% because he makes that for sure. Okay, and you know this is going to be 952.5. Okay, so that's the idea. Well, what about the second bracket? Well, now we know that he already paid taxes on $9,525. So now we need to calculate how much is left based on this bracket that he's in right now. Right? Does he make more than $38,700? Yes. So he would definitely reach the cap of the second bracket. So that means that if he's going to reach the cap, he's definitely going to pay up to the last dollar of this cap, right? But he already paid $9,525 at a 10% tax rate. So we have to discount that. Okay. So in this case, what's left for the second bracket for the 12% tax rate is actually $38,700 minus what he already paid, which will equal $29,175. Okay, so in this case, he will pay $29,975 at 12. He's going to be charged a 12% income tax. Okay, and if we do that, we know that he's going to have around $3,500 in tax. Okay, for the second bracket. Oh, wait, is he done? No, he makes $40,000. There's still dollars here of income, of adjusted gross income that he hasn't paid taxes on. Does he make more than $82,000? No. So this is where we stop right here. Okay. So that means that now we're going to, instead of getting the cap of the bracket as you've done here on the previous one, we're going to get the amount of money that he makes, which is $40,000. We're going to discount all the money that he already paid taxes on. So the $38,000 Okay, and if that's the case, we know that now he has left $1,300, right? So for the third bracket, he's going to have $1,300 times 22%, because it's in the third bracket due to the level of income that he makes, which would be $286. Okay, so in this case, if you sum all that he owes in terms of the income tax, you see that he actually owes $4,739.50. Okay, which will be letter A. Okay, so hopefully now you get an idea about this marginal tax works. It's not actually, if you make $40,000, you pay 22% of $40,000. It's per dollar that you make, you will start reaching different levels of the bracket, and then you get taxed a higher level on the extra dollar that you're making. Okay, please let me know if you have any questions. This is not something that we tend to think about right away, so it tends to be a little confusing right away, but once you get it, and I'm completely confident that you guys can do so. Okay, so reach out and we can talk through Zoom if needed as well. So how does the income tax historically plays the roles in the US? We have experienced both really high and really low levels of taxation. So in the 1913, when we saw that series of bank fails, as we talked about in the money and banking class, actually the highest marginal tax rate was 6%. How crazy is that, right? That's very, very low. That's less than the lowest tax bracket today, which is 10%, right? But at the same time, we've seen very, very high levels of taxes. So once we recover from that recession, right, in the 1913, you can see that in 18, we raised taxes to pay out all that debt, which is not something that we've seen so much lately, maybe, right? So for example, in 1918, the top marginal tax rate for income was 77%, right? In 1945, it got to 94%. Can you imagine that? Every $1 that you make, once you reach the last bracket, 94 cents of that dollar go back to the government. That's insane, right? Based on the world that we live in today. But you can see that the economy has changed. And that's one of the cool parts of understanding fiscal policy and looking back in trends to see how government has changed, how it works over time.